We're recording this video Thursday, 8th of March 2012. Today was Contract Rollover Day, and on Contract Rollover Day I always get a bunch of emails from people asking what is going on, what contract should I be trading, and so on. So I thought I'd do a video. I need a video on the site kind of talking about this as a reference video. So I'm going to start a little bit from the basics, so apologies to the old hands. I'm just going to talk about expiry dates, rollover dates, and continuous contracts. So let's get into it. First of all, the Emini is a futures contract that expires quarterly. We've got March, June, September, and December dates. The contracts are denoted with letters H, M, U, and Z. So, for example, we've just been trading the ES12H contract, or on some platforms it's ESH12, which was the March 2012 futures contracts of the Emini. Now, that contract will expire on the third Friday of each of those quarters, so March, June, September, and December. So the end of the quarter, that contract expires. Now, at expiry, trade in that contract will cease and the trades are settled. Now, suppose the Emini is an index futures contract based on the index, the S&P 500, and so this whole idea of contracts expiring and quarterly contracts and so on was more, was invented really to do with agricultural commodities, where there was actually physical delivery of goods, of corn, wheat, bellies, whatever it might be. With indexes, we've kept this same kind of system, but it's a bit of an anachronism. We don't actually need this for index contracts, because in fact there's not actually physical delivery, but there is settlement, and so this is the construct within which we trade futures. So that's what contract expiry is, but the more important date is actually the contract rollover date. The rollover date happens before the expiry date, and it is when the majority of trading moves to the next contract, from the old contract to the new contract. And the convention is, for the Emini at least, is that this day is on the second Thursday of each of those months, March, June, September, and December. And that was today. Thursday the 8th of March was the second Thursday. Now, there's a little twist in it. If the rollover month starts on a Friday, then it's the first Thursday of the month. So, just a little bit of a quirky thing there. And so trading on the rollover day switches from the old contract to the new contract. And what I suggest you do is actually trade on rollover day the old contract, and then the day after rollover day switch to the new contract. Or, if you like, just avoid trading the rollover day altogether. You'll only miss four trade days a year by doing that. But sometimes, the signals are a little less clear. There's a little bit more chop. There's not the pace on the tape in terms of kind of contracts going through, because they're split on that day effectively between those two contracts. So that's what rollover day is. Rollover day is kind of a couple of weeks prior to expiry, and that's the convention where everybody starts moving most of their volume onto the new contract. Okay, now on the website Emini-Watch, all of that information is actually there. What you need to go to is under the Emini Trading tab, what are Emini Futures, or in the sidebar there's a little link to what are Emini Futures. There's a whole article on Emini Futures and the facts about them. And if you go to the very end of that article, you'll see a section on Emini Futures contracts expiring every quarter. And that's where I just have this information listed about the rollover dates and the expiry dates. So if you need somewhere to be able to kind of check that information, and of course I'm always going to the CME website, so cmegroup.com is the website address, and you'll find that information for rollover and expiry dates for the Emini contract there. Now, what does that mean for us kind of trading? And particularly what I'm going to be talking about is continuous contracts and the way TradeStage, for example, deals with these contract issues. So what I've got here is a chart just showing you the three contracts. So this is ESH12, which is the March 2012 contract for the Emini futures that we've been trading up until today. Next to it, I've got the ESM contract, ESM12, which is the June 2012 contract. And then beside that, what I've got is the @ES.D, which is the continuous contract. So the continuous contract is a combination of each of the current month's trade. And the reason why we use continuous contracts, they're very useful because they show you kind of full back history, and particularly they were particularly invented for back-testing trading systems where you wanted to test 5+ years of trade data in order to get a sense of the profitability of a trading system. In the old days, what you had to do was basically 5 years would be made up of 20 different futures contracts, and you had to run your system 20 different times and then aggregate the P&L for those 20 different contracts to figure out your final numbers. Well, the convention, it became a simplification to create a continuous contract that's going for all of that period, so you can just test your system kind of once. So TradeStation, I think, were one of the early adopters of using continuous contracts ubiquitously. It was very easily available within their charting platform, and it's one of the things that I like that makes kind of life simple and easy, kind of going back over time. But 4 times a year, you get this kind of rollover day when things get a little bit kind of odd, and you just need to be aware of what's going on. So, first thing to note is that today, in terms of the volume trading, this is the old contract, what's just we're rolling over from, which is the March contract. You can see the volume we've been trading over the last couple of months has been really significant, in the million kind of contracts plus a day. And if you look at that over time, this contract kind of started trading back in second week in December, and that's when the volume really came into that contract. Previously, the contract was trading. We had price points throughout that period, but the volume was negligible. You can see it's actually virtually zero along the line here, and it's only until that contract becomes live that people put all their volume through it. And the similar kind of situation happening, this is the M12 contract, which is the June contract, and you can see there's been no volume traded really until today. Now today, which is rollover day, where we're supposed to be switching to the new contract, let's look at the numbers. So today's trade, we had 1.8 million contracts traded in the old contract, but only 0.9 million contracts in the new contract. So this is kind of a typical pattern. The volume has switched over. There's still pretty high volume in the new contract, but still the majority of the trade is going through in the old contract. What TradeStation does for constructing the continuous contract is to move forward to the new contract. So what we have today's date, we've actually got 0.9 million contracts traded, which is the new contract, the June contract, that kind of has gone through here. And if you look at the closing prices, 1360.50 is the closing price, which is the closing price of the continuous contract here. So we've switched to the continuous contract today, and yet the closing price on the old contract was 66.50. So we're actually trading at a discount to the old contract, if you like. So we've switched on rollover day on the continuous contract in TradeStation data to this new contract, but in fact on rollover day we still had the vast majority, or a good portion of the trade, the greater portion of the trade, kind of going through on the old contract. So just bear that in mind. Ideally, I prefer if TradeStation were actually rolling over the day after, but that's not the rules. That's we're supposed to be trading the front contract, this kind of new contract, but in practice, everybody's kind of trading this old contract. So that's what's going on. Now, how is a continuous contract traded? Because there's a difference in price, these things don't match up. There's usually a premium or a discount kind of based on the forward expectations. At the moment, there's a discount, so we're expecting June to be 6 points less than March, if you like. When we've been in strong bull markets, it's actually the other way around. We're usually trading the forward contracts as a premium to the current contract, the old contract, but in fact in this case we're actually trading at a discount. Now what happens is TradeStation needs to recompute the old data based on this new difference between the closing prices actually yesterday. So let me show you this on the continuous contract. So this is the 3 contracts shown with a good deal of kind of price back history here. At ES.D, which is the continuous contract, the at symbol shows you as a continuous contract in TradeStation, and that's plotted in green along this chart here. And then you can see we've got 2 other lines. We've got the H contract, which is the March contract, and the M contract, which is the June contract. Now, because the data has been adjusted, the continuous contract, you can just see that the blue cyan is just overlaying this green continuous contract. So the current month data is the same as the old month data, and the old contract, the March contract, is being shown here above the continuous contract because it's actually trading at a premium to the current contract. So yesterday, if I were to have brought up this chart, the continuous contract, the green price data here, would have actually overlaid this orange data for the March contract, because the continuous contract was still the March contract. As we rolled over to the June contract, the data in TradeStation was adjusted and shifted down by 6 points or so across all of that back history. So that's why you might look at a continuous contract chart after rollover, and the price points will actually be different. The shape of the chart will be identical, the volume will be identical, the signals will be identical. It's just what the price actually is will be different because we've adjusted for that difference in contracts and prices. So hope that kind of makes sense. Now, just as a practical matter, when contract rollover happens, you'll actually see a good deal of chop. So this is today's trading on the Thursday. This is the overnight session. This is Wednesday. Now, at the close of Wednesday, we flipped over, the charting packages all flipped over to using the front month contract, the new contract, and there was a good deal of volatility in the price actually being plotted around that time. We actually had, the market was pretty volatile during that phase anyway, but usually you'll see a good deal of kind of price chop happening in the course of maybe just one or maybe two bars, and that kind of just reminds me, oh, okay, there we go, contract rollover. What's is what's kind of making the data look a little bit flunky now. And what I always do is, first thing I do is I refresh the data in all of my charts. So I hit Control R to refresh all of the data on my charts. I shut down all my charts in TradeStation and restart TradeStation, and that should reload all of that back history data, and it should be correct. Occasionally I suppose there might be problems with that back history, and what you might want to do is flush your cache, which is kind of go into the cache folder within your charting platform, delete it or rename it. With your trading platform shut, you've got to close your platform before doing that. Then reopen your trading platform, and then that cache data will be re-downloaded from fresh, and it'll be kind of good clean data. But just be aware, around that time period, there's a little bit of chop in the data, and so just to refresh your charts. Now, in terms of trading signals during that day, because we've kind of rolled forward to the new data, and the new data is only being based on a third of the volume. The majority of the volume is kind of going through on the old contract. One of your options is not to trade it at all. That was what I actually did today. For me, I saw it, the market was moving pretty slowly. There was a really nice setup, which I'm just about to show you, but for me the market was moving really slowly, so I decided not to trade it. This is what the chart looks like on a 1500 tip bar chart for the continuous contract. So this is rolling over to that new contract, and there wasn't so much trade going on. So you can see the amount of number of trades, because each of these bars is 1500 trades or ticks kind of going through. There's not a lot of trade. If I compare that with the at ESH12, so this is the old contract, this is the trading day, exactly the same kind of bar spacing here on this chart. The bar spacing is 4 on this chart, and this is the amount of trade that went through on this day, on this contract today. This exactly the same bar spacing at 4. This is the amount of trade that went through. So it was literally 1/3 of the trade that was happening on the old contract, if you like. On the new contract, overnight we'd had the market kind of shoot up into the 60s type level. We reached a cyclical resistance point. We fell back down, found support. It was actually a flush pattern. So we'd had exhaustion, selling, bullish divergence around a support level, which again, everybody knows this is a nice little setup that I like kind of trade taking for a reversal of trade, a trend. The market had kind of just peaked out yesterday, kind of come down a little bit. We had that at the end of the day, and we actually moved forward. And then when we had a flush signal at support, that was after a change in trend here, that was a good signal to kind of take a long trade. We've broken in this chart into an uptrend. Similar type of pattern on the 1500 tip bar chart on the at ESH, so the old contract if you like. So the end of yesterday we had exactly the same thing, exhaustion selling, bullish divergence. Overnight we kind of peaked there, but instead of a flush pattern at the beginning of the day, we had another exhaustion selling and bullish divergence pattern kind of come in at cyclical support. Rambo patterns here, blue professional bars step in, bunch of blue professional bars here. This little exhaustion buying signal is actually, basically a rush for people to buy the contract, so like they're buying this as we go forward. That formed the bottom of this move, and then we've had exhaustion buying and bearish divergence signals kind of come in, but because these have happened after we've got a trend move, this is happening on the left shoulder. We need to wait for the pullback to end of trend. That was a really nice signal for the top of the day. It was a flush pattern at the end of the day, so that whole move from the bullish divergence here right through to pullback to end of trend signal here was a beautiful little kind of trade signaled on this, and this was marked on the old contract if you like, the H12 kind of contract, and the at ES contract was showing the same type of pattern, the same type of signal, but slightly different in terms of, because of the volumes that were kind of going through. So my suggestion would be, if you're going to trade rollover day, I would actually have both charts open. I'd have all your charts open with the at ES contract, and then I'd just set up a duplicate set of charts side by side using the old contract, so the at ES or whatever the old contract is, to see them side by side. See where the majority of the trade is kind of going through and the volume going through, and you'll be able to see that by the pace of the trades. So the charts, if you're using tick bar charts, the speed at which new bars are being drawn should be quicker on the older chart, if that's where the majority of the volume is going through, and then take your signals off that older chart is what my suggestion would be. So there we go. Hopefully that was helpful to you. It's one of those wrinkles. It's something you've got to get used to. Ideally, I don't think we actually need it on index contracts, but we're sitting in this kind of old paradigm of futures contracts, and so that's what we kind of have to live with. There we go, and I'll make sure I have this video kind of available at a suitable place so you can reference it in the future, just talking about contract expiry, contract rollover, and continuous contracts.